Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, the U.S. and EU reaching a trade deal. We'll break down the details of that agreement and what to expect from China talks underway today. Plus, the Federal Reserve rate decision due out this week as President Trump renews his calls for a rate cut. Will the central bank keep rates on pause? And meme stock trading has returned to Wall Street. What companies could be next on the list for retail traders? We'll discuss with global data firm S3 Partners. First, let's get a check of the markets, though we are seeing a mixed picture. And really, we have seen this pretty commonly in recent days, where you get a bit of a divergence between the Dow on the one hand and the S&P and the NASDAQ on the other, partly reflection of the outperformance we continue to be seeing in tech stocks. And of course, we're going to continue to focus on those this week as we're getting earnings from four of the Magnificent Seven. Right now, the Dow down about 70 points, but the S&P bumped up by just 0.1%, and the NASDAQ up 0.4%. Both of those indices on track for another record close. And of course, in the bond market, the Federal Reserve very much in focus, as is a raft of economic data that's out this week. Right now, we've got the 10-year yield little changed at 4.41%. Now, you're looking at live pictures of President Trump and British Prime Minister Keir Starmer in Scotland, the two meeting to hash out trade deal details. The meeting comes after the U.S. and the European Union reached a massive trade agreement over the weekend. Here are the details of what's in the deal, who stands to win the most, and also, by the way, what's not in the deal, because there are still some details that are still being worked out. But we're joined by the host of Yahoo Finance's Market Sunrise, Ramzan Kamarali, with all of this. Hi, Ramzan. What can you tell us about the deal?
Hi, Julie. Yeah, so overall, it's a 15% tariff on EU imports coming into the US in general on most goods. The deal basically has come about. I think it's been met with a sense of relief more than anything else. I don't think the champagne corks are flying per se across Europe, but it has been met with a sense of relief because remember, on Liberation Day back in April, we were looking at tariffs for Europe of between 30 to 50%. So there is some relief there. But don't forget, before President Trump took office, according to EU estimates, the tariff rates on both sides was just 1%. So this is still an increase in the amount of levies that are going to be having to be paid on European imports into the US. Now, there are certain winners and losers. Just look at the car industry, for example. If you take German cars, around 30 billion, maybe $35 billion worth of German cars alone came into the US last year. And the tariff rate there we were looking at 27.5%. That's been dropped to 15%. So you think you'd get a positive response from shares. But as you can see there, Volkswagen down almost 4% today. There was a positive response at the start of the trading day, but then since then, when traders have started to look more closely at the detail, those stocks have started to retreat. It's a bit of a confusing picture on pharmaceuticals, for instance. The EU were very adamant to say that the 15% pharma was included in the 15% levy, but that's not been quite confirmed yet either. But one of the big winners you've got to say, is US energy. The EU, as well as the $600 billion that they are going to invest into the US, they're also going to be spending around $750 billion on US energy as well. So US energy, a big winner. And aviation on both sides, on the EU side and on the US side, looks like a winner as well. The European Commission President Ursula von der Leyen said that certain strategic products within aviation would be tariff-free on both sides. So there are winners and losers on both sides. But I'll leave you with one thing, though. There are 27 countries in the EU. All 27 have to sign off on this deal, and that's not a complete given. And the French Prime Minister today said today was a somber day for Europe.
Interesting. So we'll see if there is some friction down the line. Thank you so much, Ramzan. Appreciate it. Well, the agreement with the EU and U.S. is far from final, as we just were talking about, with many details still to be ironed out. Meanwhile, U.S. negotiators are jumping right into their next big round with China. Talks with that country began in Stockholm today. Joining us now, Zoe Liu, Council on Foreign Relations Senior Fellow, as well as Terry Haines, Pangaea Policy Founder, and Yahoo Finance's Washington correspondent, Ben Werschel. Ben, let's start with you here. We've got this deal with the EU. Now they're going right to these negotiations with China. What should we be looking for?
Yeah, so this is going to be at least 2 days of talks in Stockholm. As you mentioned, they kicked off just a couple hours ago. Trump just a couple minutes ago confirmed that, and also said his focus there is on market access. He wants China to open up to the U.S., which is commentary we've heard from Treasury Secretary Bessent as well, who's the leader of the talks. The bottom line, though, in terms of what markets are watching here, is an additional tariff deadline extension. Right now, we have an August 12th deadline where tariffs could snap back to its current rate is 30%. It could go back to triple digits if there's no progress there. That's agenda item number one for these negotiators as well as for markets. Treasury Secretary Bessent has said that is likely, and so a lot of signals are there that extension will be granted for perhaps another 90 days while the negotiators continue on a range of other issues. Another big issue being watched here is whether there's any announcements in terms of a Trump-Xi meeting, which is expected to occur later this year if progress continues to be made. There's a bunch of fronts which that could happen. So those are the two big immediate term issues. But these are talks that now have a huge number of much more complicated issues they have to get into. Trump was talking about currency last week. That's just one of these many issues that they have to figure out. Not expected to be dealt with today, but they kind of beginning that process in the coming weeks. But that first deadline, of course, is not having tariffs snap back in just a couple weeks' time.
Right, exactly. Zoe, is there anything we can sort of take away from the way that the EU process works and extrapolate that for China?
Julie, I do not think the EU's model is going to be a good template for US-China negotiation for two reasons, primarily. The first one is China has been the only country retaliated against US tariffs very resolutely and very firmly, whereas the EU has not been retaliating to the same extent as China. And then secondly, the Chinese government seems to be aware that on the one hand, the U.S. market and U.S. manufacturing sector is very much dependent on input or intermediate part imported from China. And then on the other hand, through export controls in particular, China knows exactly where to hit back. So from that point of view, I do not think the EU-US template is going to work for China.
Terry, what do you think? I mean, and clearly it looks like the administration is already managing expectations that a China deal is not getting done this week, right? In fact, they're likely to push the deadline back by maybe 90 days.
Great to be with you, Julie. Two things. First, directly on the investment. The concern is from the United States side is that they don't want Chinese investment in a lot of areas. I mean, let's remember the United States forcing TikTok out of the Chinese version of TikTok out. Let's also remember there's now a grassroots effort to stop China buying farmland in a lot of different places. So there's a lot of real national security concerns. The way Bessent has put this is he uses an above the line, below the line deal. But below the line, kind of normal goods, if you will. What the United States is trying to do is normalize trade with China. That's very good news for markets. Above the line, of course, national security, armaments, that sort of thing. So chips, we're normally not going to deal on those things. But secondly, the way that back to your point about the EU, the way markets have been looking at these deals is kind of the fact of the deal is much more important than the details. That's generally the case, and the deals will stick. On China, though, what you got is a situation here where what markets think is that we've already dealt with this kind of rare earths for some chips deal. That's not so. Lutnick finesses this. I'm not saying he's lying or prevaricating, but he is finessing it, because the export licenses on both sides aren't done, frankly, and the flow is not happening. So the first job in Stockholm is to get that flow happening. After that, I think they can work on normalizing trade relationships. But there's a lot of geopolitics here that are going to play in too.
Terry, I'm also curious just to get your take on the EU agreement, right? And to your point, a lot of details still to be worked out, but we got the headline about the agreement being done.
Sure. Three things briefly. One is, as I say, the fact of the deal, I think, is much more important than the details. The details will take a while. They take a while, frankly, because, as Ben noted, there's 27 countries that have to walk through this, and that's going to take a little while. And that's been one of the big sticking points on a deal. Secondly, I'd look for a positive. I'd look for a geopolitical positive here, and geopolitical risk is something that weighs on markets. This is the United States and their allies together with non-aligned countries in different deals, kind of coming together to stem China's rise a little bit, and it's a positive geopolitical moment for the Western allies, I think. Finally, what it says to a lot of the conventional wisdoms that were negative on tariffs to begin with is that what is in the mutual interest of the United States and the European Union is continuing to increase trade, and they will do that even with some tariffs and some trade restrictions. So I think all qualified market positives.
And Zoe, let's take that last bit about sort of the mutual interests. Where do the interests of the U.S. and China align that could allow some progress here?
So far, the overlapping shared interest between the United States and China perhaps has dramatically narrowed, not just because of starting from 2018, trade tensions combined with export controls, combined with broader geopolitical tensions, such as relationship between China and Russia in the context of Russia President Putin's invasion of Ukraine. But on top of that, Chinese government has already made the dedicated resolution to pursue self-sufficiency or self-reliance, not just in terms of diversifying trade away from the United States, given rising trade tensions, but also from financial sovereignty, developing alternative non-dollar-based financial infrastructure, and more importantly, on tech. So from the short term, China, especially in the context of a current U.S.-China trade negotiation, in the short term, China would want a tactical agreement from the United States in terms of relaxation of export controls. But in the long run, what China wants is to achieve better market domination, not just in terms of lower end manufactured good, but made in China, cheaper, better, and of higher indigenous tech content. So from that perspective, the overlapping interest between the United States and China has dramatically narrowed.
Yeah, and it feels like a tall order maybe to get all of that. Ben, what do we know about how long this round of negotiations is going to last? Is it just today and tomorrow, and then they kick the can a few months?
Yeah, I think that's about right. This could push into Wednesday. I've heard signs that they could extend it by a day if there's more to talk about. But yeah, it's only for a couple days this week, and then a lot of the trade negotiators actually have to get back to Washington because of other deadlines that are looming on for other countries that we've been talking about for this Friday. But yeah, this is expected to be a kind of limited conversation on a couple of these issues. One other issue I'll add to that we haven't brought up is oil there, especially in the Russian context. We had some news from President Trump this morning. He's going to lessen the deadline for Vladimir Putin, and if that doesn't go in his view, he's going to move forward on his plans for secondary sanctions or Russia or secondary tariffs. China's watching that closely because they're obviously a big consumer of that. So a lot of details there to remain to be seen, but that's another topic of interest for sure this week.
Yeah, a lot on your bingo card to pay attention to, Ben, and all of us for that matter. Terry, you're going to stick with us. Zoe and Ben, thank you so much. Appreciate it. Coming up, President Trump today reiterating his call for the Federal Reserve to cut rates, but the market sees little chance of that happening at the Fed meeting this week. We're going to preview that meeting and this week's economic data with an economist next. Stay tuned. You're watching Market Catalysts. The Federal Reserve is widely expected to hold interest rates steady at its July meeting this week, as chances of a cut in September hover around 60%. Joining me now, Stephen Juneau, BofA Securities senior U.S. economist, as well as Terry Haines, Pangaea policy founder, still with us. Stephen, so when we look at the expectations around Powell here, as I said, not the expectation that we will see any kind of cut to rates, but what do you think is going to be the message here from Powell this week?
I think it's going to be more of the same. It's going to be a wait and see message. There's really no rush for the Fed to cut. And we have to remember that Friday they're going to get the all important employment report where they might see some evidence. So why do you want to front run that? And then further down the line, the Fed has Jackson Hole, where it gives them another opportunity to maybe guide the market. So I think it's really a wait and see. We haven't seen material weakness on the labor market emerge yet. Inflation is kind of stuck at 2.8% when you look at core PCE, or 2.7%. So there's just really no rush to do anything at this meeting.
So, Stephen, it sounds like you're kind of on the same page as the Fed, that they are safe to sort of wait and see what's happening, and that the data has not justified yet a cut to rates.
Yeah, absolutely. I mean, I think that's the right approach for now. You have to wait at this point in time. When you have this dual mandate and you have this tension between the dual mandates where inflation is running above 2%, and it has been for a few years now, and you have upward pressure finally starting to emerge from tariffs, well, you want to be cautious with cutting into that, even if they are more of a temporary driven price hike. Even if it does mean that inflation is not going to be super persistent, you need to see evidence of that. And then when you have the labor market with limit rate at 4.1%, well, you just don't need to respond right now. There's no real need to kind of cut rates or ease policy rates today. And you have time, given where the economy is today, to really evaluate where things are headed, evaluate where inflation's going to go, evaluate where the labor market's going to go. So really, this meeting is more of a holding period, and then we'll see what happens over the next few months and how the data moves.
Well, of course, there's the economics of all of this, and then there's the politics of all this, and that's where Terry sort of comes into it and where his perspective comes from. Again, we had the president this morning saying he thinks the Fed should cut rates. What is all of this theater all about? The two of them meeting at the Fed, et cetera, all of the tweets and the rhetoric around this. What do you think it's all about, Terry?
Well, at some point it's going to occur to people that are out there trying to, quote unquote, defend the Fed, some of whom want Powell to resign to defend the Fed, which is hilarious. But it's not about removing Powell. Powell is Trump's scapegoat for stubbornly high prices in anything economic that's not getting corrected fast enough. Every time Trump talks about Powell, now we have multiple news organizations, including this one, having him on air talking about it, so that message gets sent publicly to the public that whatever you're concerned about isn't Trump's fault. It's these swamp people that we're concerned about. And finally, Trump will get credit whenever interest rates fall. And if I remember correctly, consensus is still 2 times this year. Trump gets credit for falling interest rates whenever it happens. So it's a win-win for him all along. But this isn't really about threatening Fed independence, and I think Hard Hat Palooza last week showed that pretty clearly because there was no follow-up on any of it.
Well, Stephen, what do you think? Do you think there is a real threat to Fed independence here? I mean, the markets don't seem, at least the bond market is not showing much concern.
I think for us as economists, we tend to think about the Fed really needs that independence to actually do its jobs. And I think what the administration also learned in kind of that firing event, we're going to fire Powell, maybe we won't fire Powell, that give and take, that pullback. What they learned is that they may not actually accomplish their goals if they were to kind of destroy or reduce Fed independence rather. So that combination of factors, the independence of the Fed, that's really ingrained in economists, coupled with the fact that the administration's objectives may not be achieved by reducing Fed independence, I think that keeps it safe. And we've heard, as Terry mentioned, Powell's not getting fired. That's what the president told us last week. It's a bit of a distraction, I think, if anything, and that's what we're going to see kind of move forward.
Yeah, maybe to your point, Trump sort of figured out he gets the best of both worlds by just continuing to say over and over again that rates should come down and not actually acting on all of these threats to fire him. Stephen, while you're here, we were just having a discussion with Terry and some other folks about the latest trade headlines. And I am curious to get your take, because sometimes we lose sight of, as we get these trade deals, quote unquote, or letters of intent, or whatever you want to call them, frameworks, we sort of lose sight of where we are now in terms of the tariff regime and where we were prior to this administration's second term. in the effects economically. Can you sort of walk us through your thinking on that, where we are in tariffs now, where we were, and what are the implications?
So I think on the positive, where we're at today is we're in a point where uncertainty is really starting to diminish. And obviously that's good for businesses, it's good for consumers. Even if we are looking at an effective tariff rate that's well above where it was just a year ago. We have to remember that the effective tariff rate was roughly 2.4, 2.7% last year. Now we're looking at something closer to say 12, maybe all the way up to 15%. So it is a big change. It's a big hike in the effective tariff rate that acts as a tax. It acts as a tax on consumers if we see that price pass through to consumers. And it acts as a tax on businesses because, of course, it pushes up input cost on things that are needed to produce goods and provide services. So we do have to remember, we always have to take a step back. There's a positive here in the fact that, yes, uncertainty seems to be diminishing a little bit. We're getting clarity about what the final effective tariff rates might land at. But we still have an environment and economy where we're going from a very low effective tariff rate to a much higher one. And that's obviously going to lead to some negative effects on economic activity over time.
Yeah, and Terry, I want to get your sort of political take on this one too, because it's interesting. The markets don't seem at this point to be that concerned about tariffs, unless you're talking about specific sectors, right? I'm curious, though, politically, how it is playing with the public at this point as we get these various deals signed. But to Stephen's point, the tariff rate is still much higher than it was. What do you think?
Well, I think on the politics of it, I think right now the vast majority of the public is confused by it. What they hear are kind of shards of good and bad things across, but they don't see, as markets didn't see a few months ago, kind of the cumulative effect of tariffs on the one hand, but combined with the trade deals and kind of unlocking markets for the United States to some extent, combined with the variety of effects from the tax law that not only include keeping the rates low, but also providing incentives for manufacturing, a variety of other things. And as Lutnick is quick to point out, that kind of the most consumerist parts of it, the no taxes on tips and things like that. So what Republicans bank on is that there's going to be confusion today. They get an opportunity to sell over the next year, and meanwhile the economy, they think, will surge, and that surge will ultimately benefit them politically. That's kind of how this is being played right now. Meanwhile, on the Democratic side, you've got folks who don't want to cut any government spending at all, something that's not that is not music to markets. And at the same time, Democrats are, as I think a Wall Street Journal NBC poll showed over the weekend, kind of at their lowest ebb in 35 years in terms of approvals. So Republicans think they get help politically in that sense as well.
We'll see how it all plays out. Stephen, Terry, thank you so much. Appreciate it. We got much more markets action coming up, including some trending tickers for you. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma, live at the NASDAQ. Let's get a quick check on the market action about 1 hour into today's trading session. What we're really seeing here is all three major indices moving slightly higher in the green after President Trump just said while on his trip in Scotland that the global baseline for tariffs will be 15 to 20%. Of course, this is adding more clarity to this picture of uncertainty that we face over the past few months as those tariff rates and negotiations have gone under play. We have the Dow, the NASDAQ, and the S&P 500 all moving slightly higher. In particular, the NASDAQ up 0.3% as investors wait on those big tech earnings when it comes to Apple, Meta, Microsoft, and Amazon, all expected to report this week. Those three companies making up nearly $11 trillion in market cap. And certainly all eyes will also be on the S&P 500 as we're getting more calls on the street of the S&P 500 really rallying this year. Oppenheimer, chief market strategist, boosting his year-end target to 7,100 from 5,950 in a note to clients on Sunday night as he said progress on trade negotiations removes an uncertainty that has weighed on our market outlooks. He is one of several Wall Street strategists who have returned to their previous S&P 500 targets that they had earlier this year. Of course, it's also important to note here that all eyes will also be on President Trump's negotiations negotiations with China. He's set to meet his counterparts in Sweden for the third time as they try to really understand or really make way within those tariffs negotiations, as they had previously announced that 30% on China imports. In addition to that, all eyes will also be on the Fed. They're expected to also meet this week as those chances of a September rate cut come into play. Those chances now up 60%. I also want to take a closer look once again at the NASDAQ. If we go into the interactive here and we take a closer look at where exactly we are now with Microsoft, Apple, Amazon, and Meta, we are expecting to hear from all these companies. Year to date, Apple is one of those companies that has struggled as they really tried to make way within that AI momentum. Investors there trying to keep a close eye on how exactly they plan to get ahead in this AI arms race. I also want to take a look at crude oil because of these negotiations, or rather this announcement from the EU announcing those trade negotiations with the U.S. at a roughly 15% baseline that is anticipated yet to be officially announced, as there has to be a vote among all countries in the European Union. We are seeing crude oil futures move slightly higher, up 2%. And once again, all three major indices moving higher this morning as we really also look to one other piece of key data out, which is this Friday. We're weighing in on those jobs report. Consensus is that unemployment will tick slightly higher to 4.2%. Also expecting more than 100,000 jobs at about 101, according to Bloomberg consensus. Investors digesting all of this. Stock, all three major indices in the green this morning. Keep it right here on Yahoo Finance. We'll be tracking all the trading, all the market moves, all the trading moves throughout today's session.
Now time for some of today's trending tickers. We are watching defense stocks, Cisco, and ChargePoint. First up, defense companies expected to benefit from the U.S.-EU trade deal. President Trump saying that the bloc would be, quote, purchasing hundreds of billions of dollars worth of military equipment. Defense stocks did initially rally on the news pre-market, but we're seeing some of that momentum die down. RTX, Kratos Defense have turned negative. Next up, Cisco shares edging lower on the back of a, quote, no drama downgrade from Evercore ISI to inline from Outperform. The analyst maintaining his price target of $72 per share on the stock, saying the company's strategy seems solid, but the upside is mostly priced in already. Finally, shares of EV charging company ChargePoint are sinking as it executes its 1-for-20 reverse stock split. ChargePoint shareholders approved the split at the company's annual meeting earlier this month as it looks to remain compliant with the minimum trading price criteria for the New York Stock Exchange. Shares down 14%. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, coming up, we're diving into the outlook for media stocks, including the latest on Paramount's merger. We'll be right back. Paramount's merger with Skydance Media is set to close on August 7th after getting approval from the FCC. Shares hit a 52-week high after the news, pulling back slightly today. Well, we've got media earnings this week as well, and we're taking a look at the media landscape and where investors should focus. Let's bring in Yahoo Finance senior reporter Ali Canal and Jason Bazinet, City Managing Director. Ali, let's start with you. What are the top three things and themes you're going to sort of be watching for in these media earnings?
Yeah, you're right, Julie. In the coming weeks, we'll have results from Disney, Warner Brothers Discovery, Paramount, among others. And there are going to be a few key themes to really focus in on. First, streaming profitability. So Disney's leaning in with now full control of Hulu. The company also plans to launch a standalone ESPN product as soon as this fall. Paramount expects to turn a domestic streaming profit this year, and that comes despite some subscriber losses. And then if we look over at Warner Brothers Discovery, we could see an upward revision to their $1.3 billion streaming EBITDA target, and that would be helped by global growth and a crackdown on password sharing. And then next, I'm also looking at this tug of war between box office gains and network pressure. WD saw a boost from films like Minecraft and Final Destination in the quarter, while Disney and Paramount saw weaker studio performance, but all three are still battling TV network declines, from ad softness to rising sports costs. That's put a lot of pressure on those legacy revenue streams, and that's also something we're seeing at NBC Universal, although there are reports that they want to double down on sports and potentially create a new sports cable network. So TBD on that. And then finally, cost control and free cash flow. Disney's cost-cutting efforts are fueling a projected 16% jump in 2025 earnings. Paramount's cash flow is expected to top last year's $489 million as the Skydance deal nears completion. And then with WBD planning to split into two separate companies, one focused on studios and streaming, the other on linear networks, investors are looking for more clarity on where capital goes from here. So clearly with all these companies, we're in a period of massive transition. We're not going to get all the answers this earnings season, but it will set us up for what we could expect down the line, and especially over the next year here, Julie.
Yeah, definitely. Thanks for sort of setting the scene for us. So Jason, as we go into this week, what are you hoping to learn, and who do you think is best positioned amidst a landscape that is sort of constantly remaking itself?
Well, I think actually from an earnings standpoint, it's not going to be the most exciting quarter. I mean, the ad market overall is healthy, but traditional medias aren't participating that much. I think a lot of the comments you made around sort of the continuing to lean into streaming is right, and a focus on profitability. But I don't think that there's any sort of, great moves. The thing I'm most focused on, actually, where there is a little bit more controversy, is around Disney's theme parks, where people are still a little bit nervous about what Epic Universe means to the parks. And a lot of our third-party checks suggest it's sort of, middling. Like we're not going to see like real strength or real weakness in the parks.
Well, and what's interesting about that, Jason, also is those tend to be cyclical. But do you think this is something that is going to take longer to catch on? Do you think it's in a sort of longer term dip maybe because of where folks are feeling economically? What do you think?
Well, Disney went through this great period where they were getting rising attendance with rising prices. And what happened post-COVID is they jacked prices up quite a lot and saw some diminution in terms of attendance, which I think was intentional to make the park experience a little bit better, to cater more towards the high-end consumer. And I think the market had real fears of a recession or a pullback earlier this year. Those have moderated somewhat. What gives me just a little bit of pause is, as it relates to Epic Universe, what we normally see when a big destination park plows in a lot of capital, it sort of rises, the rising tide lifts all boats, and you'll see the share shift to the park that deployed the capital. But in general, it's a good thing. That's what we're not seeing down in Orlando right now, no matter what third-party data we look at. We've seen, big capital investments by Epic, but we're just not seeing this surge of airline traffic, higher hotel prices, higher ticket prices. It's just sort of middling. It's not really exciting. Yeah. So I don't think it's a macro comment. It's just the consumer doesn't seem to have responded the way they have in the past of big CapEx cycles.
Interesting. There's another theme that I know, Ali, that you are watching, and that's the relationship between these companies and the sort of legacy linear cable networks that in some cases they're still putting money into, right? Or there's still at least reports that there might be more investments.
Right. I brought up that NBC Universal report that they're considering launching that sports-centric cable channel. Now, this would also air on Peacock, so there would be some relationship between the streaming side and the linear network side. But we've seen in these reports time and time again that linear ad revenue just continues to plummet. There is nothing that these companies can do to really claw back from those declines as consumers cut the cord. This is just a natural evolution that we've been seeing. So I have a big question of why legacy media cannot seem to fully break up with cable. And Jason, I wanted to pose that to you because it feels a little counterintuitive considering the moves. At the same time, though, we know that these companies make a lot of their revenue from cable, and sports is a big driver of that.
Yeah, I mean, I just think it is. It's what happens in a lot of declining industries, right? Where your optimal move, whether it's a tobacco company or a linear cable channel, is to just sort of raise price and sort of let it play out and get as much cash flow off that business until it goes away. So I don't look at, there's no strategic debate among the executives or investors about the importance of it. Everyone knows it's declining. The question is, how much aggregate cash flow can you sort of skim off that business before it goes away?
And so, Jason, when investors are trying to decide where, if anywhere, within media to put their money, you had a really interesting note recently where you framed it sort of differently than sort of streamers versus legacy or what have you. You framed it as open versus closed, right? Sort of a gatekeeper-led company like a Netflix versus something like YouTube, which is creator-led. And how do you think that's going to play out? And is that indeed the better place for investors to be on those sort of more open systems?
Yeah, it's really strange because, the internet has been around for what, 30 years? Smartphones have been around for 15, and suddenly in the last 18 months, we've just seen, no matter what rock we turn over, just real signal that consumers have a strong preference for open platforms over closed. So it is YouTube, versus Netflix is one example, but it's also happening in the video game space. It's happening in the publishing space. I think that's where you want to go. Why is it happening right now? I think there's a couple of vectors. I think AI is allowing the right content to be surfaced in these open platforms more successfully. That's capturing consumers' attention. Consumers' attention spans, I think, are shortening. And a lot of these short form types of content are more amenable to open platforms relative to a 1 hour TV show or a two hour movie. And so those are two powerful vectors that I just don't see changing. So I think open is preferred over closed. And the real question, frankly, is are we going to see companies change their strategy? That's what we haven't yet seen. I mean, we still have legacy media companies in the closed ecosystem battling it out to try and get viewership or ratings points or ad dollars. But there's a whole parallel ecosystem happening where there seems to be a natural tailwind, and yet we haven't seen any traditional media company really lean into these open platforms that don't have a gatekeeper.
Yeah, it's a good point. We'll see if anything, they're big, sort of slow-moving companies that maybe we'll start to see some change incrementally over time, but it's an interesting contrast. Jason, Ali, thank you very much.
Thank you.
Coming up, most likely to meme. We're getting the latest data on short interest in the market and where meme stock mania could strike next. You're watching Market Catalysts. Meme stock mania returned to markets last week with heavily shorted stocks like Opendoor, Krispy Kreme, and Kohl's rocketing higher. This comes as U.S. short interest overall rose by $79 billion over the last 30 days, hitting $1.5 trillion, according to research from our next guest. Here to discuss what's driving this momentum in the market is Ihor Dusanowski, SV Partners Head of Predictive Analytics. It is great to see you, Ihor. How are you?
Fine. Great to be here.
So we always come to you at moments like this to try and figure out what is sort of going on under the surface in the market here. And this sort of new crop of meme stocks, right? What have we seen in terms of short interest in these companies?
Well, we've seen short interest actually increase even as stock prices have gone up in these meme names. This is not unusual. You've got people on the long side and the short side. We've actually started looking at the long side of the market a lot. And it's not a one-sided deal where the meme stocks are going against just the short positions. There are hedge funds that are actually trading long along with the Reddit guys and riding the wave as well.
Yeah, so that's been interesting. And I guess another, we've been trying to sort of discuss the differences between this latest run versus meme stock, when it first came up in sort of 2021. And I guess that's one of the changes is that the professionals have sort of caught on, right?
Yeah. I mean, you never let a good opportunity go past you. They're really looking at whatever is a momentum play. So if they're seeing the retail side pushing stock prices up, a lot of them are shorting because they're seeing stocks that are overpriced, but a lot of them are jumping on and saying, hey, I'm going to go along with these retail guys and go along and try to make some money on the upside. The big difference is that these institutional long traders are really good at getting in and out of positions. And sometimes retail guys left holding the bag because they're the ones that are holding on for longer than they should be.
Right, which is something that we saw happen the last time. Potential new sort of next wave meme stock, short of, scrolling Reddit or some of these message boards, the characteristics that some of them seem to share is they sort of have name recognition, in some cases maybe even sort of millennial nostalgia factor, and the high short interest. Are there any names that we haven't seen get memed yet that might fall into that category?
It's really tough to call what's going to be on the Reddit boards. But there are some names that kind of fit the mold. We're looking for, again, is high short interest float, a name that's relatively familiar. Some names that, kind of we would know are something like Cracker Barrel, Tootsie Roll, Hertz, Whirlpool. These are all names that have high short interest, and there's a lot of battleground to this names where there's long holders and short holders. But you never know. I mean, these might be some of the next names that get on people's radars.
Yeah, and some of them have sort of cropped up on some of these meme stock lists before, like a Tootsie Roll, for example. So when you talk about battleground stocks, when you have the long and short holdings here, what tends to happen in those cases, and what's coming up on your screens for those?
Yeah, this is a really interesting development that we've kind of just jumped into. We're seeing hedge funds, active investors, not the passive guys that are, the ETF guys, the index guys that are just long and hold long forever. We're seeing active investors, the hedge funds, going long and short the same names. So what you've got is dry powder on both sides of the market. You got a ton of guys long, ton of guys shorts. If the stock price goes up or down, you've got volatility in this name where you got the price just shooting up because one side or the other capitulates, and you've got a excess of return on one side or the other. It's really interesting because these names are the names that people should be looking at.
Yeah, it's interesting stuff. And so the names that we're talking about in this case, you've got something like a Fubo on the small cap side, which has been sort of memed in the past. AMC, obviously that too. You mentioned Cracker Barrel, Kohl's already, Wolfspeed. So what tends to happen, or what has tended to happen in the past when you have these stocks? What does the price action look like?
This action is actually, so if we see a trend higher, the shorts are getting smacked around a little bit, so they'll end up buying the cover, and the longs get longer. So what you got is, a stock price that might be going, relatively flat or slightly up, gets a shot up really quick because you've got this action on both sides. You've got the shorts covering in the buys and the long guys buying. You've just got an accelerated price move in a lot of these names. So it's something that if you're managing a portfolio or you're even a retail investor, you should know that these names are that scary sometimes, where the market goes up, you're going to do really, really good. But if the market goes down, you're going to get crushed really fast.
Yeah, good to remember for folks. Ihor, thank you so much. Take care.
Thank you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, big tech facing an $11 trillion earnings test with Meta, Microsoft, Apple, and Amazon set to report. We'll dig into what to expect in today's investor playbook. Plus, the U.S. and China kicking off trade talks today. We'll look at how the retail space is positioning for trade uncertainty. And digging into retail, we'll look at why JP Morgan is bullish on Nike's turnaround plan. All that and more coming up on Market Catalysts. Well, 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We've been seeing a mixed picture today. That continues. Really, you can call the Dow and the S&P 500 little change, but any gain for the S&P today will be another record close. The Nasdaq gaining a little bit more, up 0.3%. And if you look at what's going on group-wise within the S&P 500, energy stocks rallying today after the EU-U.S. trade deal that includes some pledges to buy U.S. energy, consumer discretionary rallying as well. We've got materials on the downside today. And of course, big tech earnings are on deck. Apple, Amazon, Meta, Microsoft, they're all set to report this week. Joining me now, Yahoo Finance tech editor Dan Howley, as well as Daniel Morgan, Synovus Vice President and Senior Portfolio Manager. We got some Dans here today to talk tech. Howley, I'm going to start with you. What are the big things you're watching for in these earnings?
Yeah, obviously we have Microsoft and Meta reporting, and then Apple later in the week. It's going to be, again, just as we saw last week, mostly about AI and how companies are benefiting from it or what plans they have. So for Microsoft, we're expecting adjusted earnings per share of $3.37. We're expecting revenue of $73.89 billion. For them, it's going to be, okay, what percentage growth are you seeing as far as AI when it comes to Azure, right? They talk about how much AI is contributing to their Azure growth. So what does that growth look like now? Last quarter, it contributed 16 percentage points of growth to Azure. Is that increasing significantly? Is it going to increase at all year over year. We want to see what's going on there. And then obviously, if they're seeing any kind of impact as a result of tariffs or fears of tariffs from consumers around the world, there's the idea of the PC side. There was supposed to be a huge upswing in the sale of PCs. And so, is that going to be impacting Microsoft's bottom line? And then on the Meta side of things, we're expecting adjusted EPS of $7.61 on revenue of $44.8 billion. For them, it's going to be, okay, well, you're spending all this money now. You pledged to spend $100 billion in these data centers. You're making big splashy hires. What does that mean for margins? Their AI is being implemented across their product stack, where they have it for consumers, where they've mentioned that it improves dwell time or usage time for users. There's also the idea of advertisers using it to build out some of their campaigns. Is that going to continue to increase? Is that doing well? And then what does that look like as far as margins when it comes to all of the spending that they're doing?
And Dan Morgan, when you look at all of these companies, which do you think sort of has the most at stake going into these numbers?
Well, it's interesting because you have, as you mentioned before, you have Apple and Amazon, which at this point in time are companies that have a little bit of black cloud over them. Meta's got a lot of positive momentum, as Dan was mentioning earlier. Microsoft also with Azure. But for example, you look at Apple, there's a lot of concerns going into this report, not only that the AI strategy isn't as strong as, let's say, a Meta or Microsoft, but there's a lot of concerns in regards to the rollout of the Near Siri tool, which was expected to come out in this upcoming iPhone 17 release in September, but now it looks like it's going to go into probably the first half of 26. And that new release, Julie, had a lot of the new AI tools that everybody was very excited about, so they thought that it could create some sort of catalyst for an upgrade cycle in terms of people leaving their old iPhones behind and upgrading to the new iPhone 17, but that doesn't seem to be the case. So there doesn't seem to be much of an AI catalyst. And in Amazon, I think their biggest issue is regards to tariffs, because they have issues with companies who are based in China, who sell products through Amazon in the US. They also have products that are companies that are headquartered in the US, but they do their manufacturing in China. So there's a lot of concerns that they're going to be more hard hit than, let's say, a Microsoft or a Meta may be in regards to tariffs. So I think, Julie, coming into this reporting cycle, there's a lot of optimism around Microsoft, as Dan was mentioning, and Meta, some of the things that are going on with them. But then there's a lot of concerns about what's going to happen with Amazon. And then we talked about Apple in terms of that delay. So kind of a tale of two cities between those four stocks.
But Dan Morgan, does that, you own all of these guys. Are there, depending on what they say, would you add to positions? Are you looking for something in particular from Apple in particular that's going to convince you that they're getting on the right track?
Well, it's kind of tough, Julie, because a lot of these stocks we've owned from the beginning. What I mean by that is we bought Facebook when it went public. Apple we bought back in 2005. We've owned Amazon for the whole duration. So we have extremely low cost basis on those stocks, and therefore it's very hard to sell them because they create tremendous amount of gains for clients, and people don't like that. In terms of accumulating shares, when you look at these, let's say these four names, they're all pretty much trading at kind of the upper bandwidth in terms of valuations. They're not cheap, so to speak. So I think, it is on our buy list. These are stocks that we look at to potentially accumulate. If we had new monies that came in where the client's objective matched up in time horizon, that'd be something we'd accumulate on weakness. But at this point, Julie, all those names are on the upper bandwidth in terms of historical PEs. So it's not like any of these stocks are really cheap right now from a valuation perspective.
Dan Halley, just from a reporter perspective, which one are you most excited about? Where do you think we're going to get some juicy details, maybe?
Could be Meta, honestly. Look, Apple, as Dan was pointing out, there's a lot to deal with there with regards to, iPhone sales. Obviously, they're the most important part of this. But then, any kind of indication as to where that Siri is as far as release. They have their public beta of the latest version of iOS out. So, obviously things are rolling, but there's no sign of that Siri release yet. And I think, Amazon, obviously with the tariff issue, will be interesting. But, I think really Meta might be the one that's most interesting just because of what we've been seeing as far as their superintelligence lab, the hires that they've been making, and the announcements regarding the data centers that they're standing up, or they hope to be standing up. I think that's going to be really the most interesting. Hopefully we get some more color from Mark Zuckerberg. He usually gives some deeper analysis of what the company's doing. I think that could be the one that really gets people interested, especially if he can say, look, again, margins may be pressured as a result of this massive amount of spending, but we're seeing improvements as far as sales go when it goes to AI. If he can do that, then I think people will be really excited.
Dan Howley, Dan Morgan, thank you so much. Appreciate it.
Thank you.
Coming up, as trade talks are underway between the U.S. and China, a look at how tariffs are affecting retail stocks. Plus, we'll be talking to Jay Foreman, Basic Fund CEO, about whether trade uncertainty is still going to steal Christmas this year from kids. U.S. and Chinese officials are meeting in Stockholm today as reports suggest the August 12th deadline for reciprocal tariffs could be extended for another 90 days as negotiations for a long-term trade deal continue. That tariff rate will be crucial for the toy industry in particular. Basic Fund, which produces things like Tonka trucks, Care Bears, and more, makes 80% of its toys in China. Jay Foreman, CEO of Basic Fund, is joining me now. Jay, thank you so much for being here. So, where do you guys stand right now in terms of the tariffs that you're paying and how you're sort of navigating it?
Well, we stand a lot better than we were at 145% on Liberation Day, but 30% is, no real consolation. I remember when it was first announced at 10, we were all losing our minds and we knew that 10 was a lot. Today, I guess we'd probably be pretty happy at 10. We're also in our industry hoping maybe for an exemption for toys, given how special this category is and how difficult it is to manufacture here in the States. But we're doing our best. I mean, manufacturers in toys and other import segments and categories kind of been eating it a bit, passing a bit of it along to the retailers, and the retailers have been passing it a bit along to the consumer. You're not seeing it a lot now. But as we get into the late third quarter and fourth quarter, you will start to see it more. And certainly as we get into 2026, the tariffs will become a cost of doing business and a built-in cost in the product. So it's going to be a trickle effect of increased prices to the consumer and lower profits to manufacturers. It's, in some ways, somewhat of a transfer of wealth.
We're showing the Care Bear video, and I'm feeling very nostalgic, Jay. So of that 30%, how much for you guys do you anticipate getting passed on?
So I would say of the 30, about 20 is going to get passed on. And the question is, will the retailers absorb some or all of it, or will it get passed along to the consumer? Again, this year's a little tricky because everybody has not been sure of where it's going to end up. So a lot more has been absorbed so far than will in the future. So I would anticipate probably 10 being absorbed by the importer, 10 being absorbed by the retailer, and 10 being passed along this year. But the fact is, as we get into 2026 and brand new items become created, those items will be designed, marketed, and sold with the tariffs built in. So there will be a reckoning. We can already see it with automobiles. It's very hard to absorb 15 or 25% tariffs plus on steel and aluminum and not be infected and all the things that are coming back across the borders between Mexico and the U.S. You're going to start to see it in cars probably more than anywhere else soon, but you'll see it in consumer products very quickly. Nobody has the kind of margins to absorb 30%. We're hoping it gets a little bit lower as these trade negotiations go on the next few days and weeks,
right,
with China in particular.
And Jay, talk to me now about the demand side, right? What have you guys been seeing there? Because there's been a lot of concern this year, especially that lower income consumers were not, that their spending power was waning a little bit. Are you seeing that in your business yet?
For sure. I mean, we are seeing a strain on the lower income consumers. Some of them aren't shopping because there are a lot of low-end consumers that shop in value stores that are immigrants, and they're worried about going out and shopping and sort of being seen. We're seeing some tension on their spending and wallets. People are holding back. But in toys tends to be somewhat of a recession-proof category where people are going to spend on their kids. I will say there'll be a bit of a shortage on the shelves for a period of time because we didn't ship for about 6-8 weeks. And there's a lag. The inventory that came into the first part of the year is selling down and selling through. Probably see a lot of empty spaces and slots on shelves right now. The retailers are struggling to really understand the tariffs and how to work the pricing, but also struggling to reinstate orders for the rest of the season. So it's going to be a really funky year this year. As always, we would suggest the toys you think your kids really want and they tell you they really want, you should get sooner than later. It's going to be a very strange Christmas season this year.
Yeah, one of the other things I was reading that you and some of your peers in the industry are doing is sort of maybe shipping stuff without batteries, for example, trying to look for some creative solutions, I guess, to bring down cost. What other things are you guys looking at?
Yeah, we call it sort of deconstructing or the deconstruction option. So we'll create a toy. It could be a Tonka truck with lights and sound in a beautiful display box. And we'll offer it to our customers several different ways. One way might be without the battery, so the consumer can purchase the batteries themselves. One might be with a sort of more simplified package or no package. And these are things that sort of take some value out of the toy, but they help to keep the price at a more reasonable level. But in the end, it still is somewhat of a tax or cost to consumers, because if you don't get the battery in the toy, and I can buy the batteries cheaper than a consumer can at retail, you might spend $5, $6, $7 to buy the batteries to put in a toy instead of having them included in a package. Try to wrap a teddy bear or a Tonka truck that doesn't have a package. It's kind of funky and it'll be, a bit of a strange shape. So sometimes that package is also part of the whole joy and presentation of the product when a child gets it as a birthday present or a Christmas gift. But we're offering the options to our partners to deconstruct a little bit, take some value out, which would sort of mitigate a little bit of the cost of the tariffs. The one advantage that the consumer has over the manufacturer is the consumer has an unlimited amount of choices, whether it's in cars, price points in cars, features in cars, whether it's in toys. You could buy a $10 plush, a $20 plush, a $30 plush, the same thing with a car or a truck. Manufacturers have limited lines. We can't just change our lines overnight and make things overnight. So we're kind of stuck with selling what we've created months, if not years ago, tooling, designs. The consumer has a lot of options. If they want to spend less or get less value, they can exercise their choice, whether it's online or in the stores.
Right. I guess good for us. Not as good news for you, Jay, but we'll be checking back in with you as this all develops. Thank you.
Thank you.
The US-EU trade deal may offer some relief to European luxury brands like LVMH. The company's CEO, Bernard Arnault, has been pushing hard for a deal, meeting with European and American officials to avoid a tariff war that he said would be extremely damaging to European companies. So how big of a win is 15%, that tariff for LVMH and its competitors? Joining me now, Oliver Chen, TD Cowen Senior Research Analyst, to talk about this and just the broader retail industry. Oliver, it's good to see you. It has been really interesting how active Arnault has been. And, he's friendly with a lot of the principals involved in these discussions. Is 15% good news? Was that better than expected, worse than expected in terms of the tariff on luxury goods from Europe?
Yeah, we're encouraged because stability and just knowing what this rate is a big positive. That being said, luxury is really at a crossroads. We have issues in China with macroeconomics and unemployment and uncertainty. We do have a weaker handbag cycle, and LVMH's numbers were slightly worse than we expected, particularly in the fashion and leather goods sector. So this all does matter in terms of cost of goods sold and pricing and what's happening, but there are a lot of headwinds in luxury goods, and we've been quite selective. We have a hold rating on LVMH. We're recommending Cartier, Richemont. Generally speaking, luxury is much better positioned than apparel, which is the worst positioned. And as you spoke about earlier, the middle and low income consumer is more at risk than higher end as well. So we're watching it. That being said, LVMH's fashion and luxury division was down 9%. Street was looking for down 8%, and we're forecasting negative trends. This is a phenomenal, iconic global company, also one of the biggest marketing budgets in all of luxury goods, and a really nice portfolio of brands, but it's undergoing harder times right now. Thinking about management here, they're very shrewd in terms of some production in the US and being geopolitically connected. That's a good thing for the future of LVMH, which is quite globally diversified.
Before we burn it out, just wanted to linger on luxury for a moment, because even aside from the tariffs, there does seem to be, to your point, the fashion and luxury business there, even as some of its competitors. Luxury's been seeing some wavering here. Do you think that it's hit bottom and could improve from here?
It's a little wait and see. This week, Gucci Kering Group reports. We continue to forecast negative trends at Gucci as well. And Zegna about flattish this week too. Canada Goose has been mixed. So luxury is undergoing a trying time. Used to be easier in China to reap double-digit growth, and now we're hovering around -5%. US has been better than expected, and Europe's been somewhere in between. What's happening is there's still some hangover from the pandemic and the stimulus customers that had money that just don't now. What's also happening is quiet luxury trends, which are quite boring luxury. We need louder luxury to work at the same time. And then what's also happening is jewelry. Jewelry's outpacing handbags. That's benefiting Cartier, and it's not benefiting LVMH. There are some winners and losers. The Coach brand is doing quite well, but that at price point is closer to $300 to $500. LV's bags start at $2,500 plus. So consumers are looking for deals and value too, and that's weighing on the sector.
Yeah, you heard it here first, folks. Oliver says, bring back loud luxury. Let's talk about the other side of the spectrum. You mentioned that apparel could be most affected by tariffs. How will it be affected? Will we see prices increase? Will we see these companies eat the cost of the tariffs?
Yeah, we were just on the phone with contacts in Asia and supply chain and looking for price increases anywhere from 5 to 20%. So we will see price increases in the marketplace. That's probably in part what's happening now with back to school shopping happening earlier and consumers being proactive about shopping as well as looking for deals. This puts department stores at risk. It puts the lower income consumer in a tougher place. And apparel's been a tough category that's highly promotional already. The majority of sourcing is Southeast Asia as well as China. So August 1st will be very important as we look at the China tariffs for apparel as well as anything that you plug in with electronics. And Southeast Asia has been incrementally worse, the rate. So that could weigh on EPS too. So it's a pretty fragile environment, but our companies have been dealing with this kind of volatility for a little while now, which is a positive. Some of the strategies include working on your supply chain to diversify as much as you can, trying to share some of this with vendors. But as we speak to vendors, there's not much margin in the system. And then as you spoke about, Julie, really trying to price engineer products in different ways and taking out different areas of product that consumers don't value as much. All these things are coming into play. That being said, as we zoom out, our top ideas are BJ Wholesale, Costco, Walmart. So we're thinking about this need plus want retailer that sells grocery and food at a good value, as well as apparel and other items. So we really need to have both.
Yeah, and how are they going to manage the want side of the equation where there is going to be more pressure?
Yeah, they're going to have to very tightly manage in terms of being price competitive relative to each other. It's promotional and consumers want value. Target is less well positioned given it's about 50% discretionary, and BJ is very well positioned given that 10% or less is imported from abroad. But we're going to see lots of promotions, but we're also going to see price increases. So it depends on each retailer. That being said, when you think about Costco and BJ's, their mission is to offer the lowest price possible, and it's a wholesale model. And when you think about Walmart, it's an everyday low price providers save money, live better in terms of their philosophy from the start. They have a lot of bargaining power. That matters too. And you layer in what's happening at Walmart with AI, digital marketplace, digital advertising. Those are alternative revenue streams and ways to please the customer that are helping as well.
Interesting. Good ideas and perspective for investors. Oliver, good to see you as always. Thank you.
My pleasure. Thank you.
We got some trending tickers for you coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma, live at the NASDAQ. Let's get a quick check on the markets. The latest moves about 2 hours into today's trading session. All three major indices looking to hold on to the momentum this morning. The Dow moving slightly lower, down about just 0.06%. The NASDAQ holding on to that momentum, up nearly up more than 0.2%, as big tech is set to report this week, with Meta, Microsoft out on Wednesday, and Amazon and Apple out later on in this week. We also have the S&P 500 still once again trying to hold on to that gains. It's worth noting that any gains made within the S&P 500 today will also be another record high. If you also take a closer look at where exactly we are right now, we've seen this momentum over the past year really hold on. We heard from Oppenheimer chief market strategist this morning. He boosted his year-end target to 7,100, up from 5,950 in a note to clients. On Sunday night, he said that progress on trade negotiations removes an uncertainty that has weighed on our market outlook. And that strategist not alone. We've heard from other strategists over this past few weeks as this trade uncertainty is now lingering behind us. They've now reversed, or rather returned to their previously set out S&P 500 target. So keep a lookout for that. The S&P 500 up more than 8% year to date. I also want to take a look at crude oil. What we've seen as far as crude oils go is after the European Union agreed to purchase roughly $750 billion worth of U.S. energy as part of that trade deal that was announced today. In addition to that, roughly 15%, of course, it's anticipated to close. We have seen crude oil futures move higher, and that's also extended into what we've seen in sectors. When it comes to energy sector, we've seen those stocks rallying once again based upon those trade deals that we have seen get underway over the weekend with the EU and the U.S. In addition to that, we also seen consumer discretionary really get a bit of momentum here, up more than 0.8%, nearly 0.9%. Of course, it's worth noting that some of the stocks that make up XLY, the consumer discretionary sector ETF here, is Amazon. It's also Tesla. It's also Nike and Starbucks. Starbucks is set to report Tuesday after market close. And we're also seeing some momentum when it comes to the tech sector here. Apple and Microsoft also gaining some momentum ahead of their earnings reports as well. Once again, we're just a few hours into the trading day. It's another big week during the summer. Keep it right here on Yahoo Finance. We'll be tracking all the market moves during today's trading session.
Now time for some of today's trending tickers. We are watching Nike, Freeport-McMoRan, and Alibaba. First up, Nike shares climbing this morning. It got an upgrade from JP Morgan. Analysts upping the stock to overweight from neutral and raising their price target to $93. They cited Nike's turnaround plans, expected recovering beginning in the second half of 2026. And the call, by the way, follows Goldman Sachs' price target raise earlier this month on the basis of strong consumer demand and adjustments for tariff rates, as some of Nike's biggest producers, including Vietnam and Indonesia, have reached trade deals with the U.S. Still with me is Brooke DePalma, who tracks Nike closely. So, Brooke, it is interesting to see sentiment turning a little bit when it comes to Nike.
Yeah, very surprising. Thinking about where we were a year ago, we are seeing that stock move higher, up 9% year over year, as the CEO there, Elliott Hill, who was named last fall, really makes this turnaround play or turnaround strategy get underway. Of course, he's trying to implement more consistent pricing, not as much price cuts that we've seen in the past. He's also trying to return to some of those wholesale partners like a Foot Locker or a Dick's Sporting Good. Worth noting, Dick's Sporting Good has recently agreed to acquire Foot Locker. And what we've seen over this past year is really this momentum for Nike to get underway, to gain back its relevance. It's since lost to maybe Hoka as well as On Running over these past few years as the strategy and the move to direct-to-consumer came underway. It's also worth noting, as you mentioned at the top, these tariff negotiations have really taken a toll on Nike. Indonesia, Vietnam, China, those are some top sourcing regions for Nike. And so seeing this company overcome all those tariff negotiations and come out on top is what investors are really looking for here as well.
Yeah, definitely. Demand and cost, both in focus here. Let's talk about shares of copper miner Freeport-McMoRan. They're taking a hit after the finance minister of Chile said in an interview with a Chilean radio station that the country is hoping to receive an exemption on the U.S.'s 50% tariff on copper imports. Shares of Freeport dropping as much as 5%. Right now, they're down by about 3%. And this is while that Chilean finance minister is in Washington and doing some talks with the U.S. on here. Freeport, one of the big producers here in the U.S. So the thinking was if there was this 50% tariff that stayed in place, Brooke, that that Freeport and other U.S. producers could maybe have an advantage. So if that's going away, it seems the investors perceiving the opposite is true.
Yeah, we're seeing this in line with copper futures. Copper futures, that ticker HG equals F, down about 3% in intraday trading as well. And when you think about just how much copper makes up, it has to do with electronics. It also has to do with automobiles. Vehicles have copper in them. In addition to that, we also know that the home builder industry also has to do with copper. Essentially, copper what makes up all our electrical wires at home. And so ultimately what was thought here was that copper was going to cost more, that consumers here in the U.S. would have to then pay higher for these copper rates. But now, based on this latest announcement, that maybe we're hoping for a bit of trade negotiation here and these copper tariffs to go away. Now, essentially, we're reversing maybe those gains that we've seen. Copper over the past, say, really 2 months is up more than 20 or nearly 21%. And that's largely, once again, because of this idea that copper was going to cost more here.
Right. And finally, on our trenders list, Alibaba. It's debuting its first ever pair of smart glasses. The Chinese e-commerce giant sharing the first look at its glasses. They're called Quark. They'll be powered by its large language model. They'll be equipped with its AI assistant. And similar to Meta's smart glasses, the new Alibaba product can be used to make calls, listen to music, transcribe, or translate conversations. Alibaba says the glasses will be released in China by the end of the year. Those shares up about 2.5% in U.S. trading. Would you wear these things? Have you tried the Meta glasses yet, Brooke?
Julie, I have never tried the Meta glasses, but I was recently at a wedding. I've been to many weddings so far this year, and one of the guests there was actually recording one of the speeches with the Meta glasses, and I was like, this is the future. And clearly now Alibaba wants a piece of that future in their hands as well. We are seeing Alibaba shares, once again, as you said, move a bit higher on this news. Shares are up about 2.5%, but year to date, Alibaba has really had this momentum behind it. Of course, being a Chinese e-commerce giant, shares are up more than 46% year to date. And so it's been pretty interesting to see how this Chinese e-commerce player has been able to come on tap. Now they're getting into this conversation. Of course, Meta out this week. It'll be interesting to hear if they have anything to say about their recent partnership with Ray-Ban as well. Julie, have you tried them though?
I haven't, but I love the idea of recording things with them because nobody likes to be at something and you got your phone up, right? This way you just look. I like that. I like it. All right, Brooke, thank you. Hope you enjoy the rest of wedding season. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up next, it is Stocks in Translation. August has a reputation for being a rough month for stocks. We'll take a closer look at the market's seasonality and what it means for your portfolio. That's next.
With July coming to an end and August trading right around the corner, in today's episode of Stocks in Translation, we are taking a look at seasonality for the month of August. And again, these are just the recurring patterns that we tend to see build in the market over time, not an exact science, and sometimes these patterns shift, but this is what I'm looking at right now. So here we have each of the 12 months, January through December, and this goes back to 1990. This shows the median returns, kind of similar to an average in green bars, and then in white, those white squares there, that is the percent 1% positive. And what you're going to see here, August, notice August, these returns are not that spectacular. It's under 0.5%. It's not negative the way September is, but in fact, it is the third worst month of the year. And we're looking at a percent positive of only about 54%. And as a background reminder, I like to see that number above 70% because stocks usually go up. So August, usually not the best month. What you want to see is what tends to happen in March, April, and May here with nice positive returns, or October, November, even December here. But if you remember, March and April were not that great this year. So that is another reminder that seasonality, sometimes seasonality gets bucked and things can intervene and markets can go their own way. And of course, the tariffs, with a brand new president this year, with Trump and the tariffs, all of that took a U-turn. And this is the U that we were looking at in the market right here. This is in white, what we have seen year to date in the S&P 500. Now in blue and in green, I have two different maps. So the blue is a median since 1990. That matches what we were just looking at in that first chart. The green is another way of looking at the market and the seasonality. This goes back to 1928, and I'm only using the days when it's the same day of the week. So for instance, today is Monday, July 28th. I'm only looking at those Monday, July 28th going all the way back to 1928. So it's just a small subset of those years. But nevertheless, I found this particular way of looking at seasonality has very powerful predictive effects because it tends to track the holidays that we've seen in years past and 401k flows and all the things that affect seasonality. So what I'm seeing right here is we are right in the market right here. We tend not to have a stumble in this market model until we get to early October. And October, as I've said many times before, is prime time crash season. We actually get an uptick in volatility in September. But September, October, November are those months that you want to kind of watch out for. So now I'm going to zoom in on August alone. And I have these same two market maps that we were looking at before. Since 1928, same day of the week, that's in green here. And then since 1990, that is in blue. And what you're going to notice is we start off the month on a downbeat. That very first day tends to be historically negative. But then in both of these models, we eventually climb out from underwater. In the blue model, since 1990, it takes about half of the month, and we finally get there about 15th or 16th of the month. And then in the other model, since 1928, same day of the week, we get to positive territory a little bit earlier, and we end the month a bit higher. So we could have lackluster returns, and of course, anything could actually happen. We could have new tariff news that intervenes and takes the market down again. We could have something like a very optimistic or dovish Fed this week that sends the market higher. But any case, I do want to close here with a bonus, and this is US dollar index seasonality. And I'm including it here because I have these two very similar models to what we were looking at before. Instead of 1990, I'm going all the way back to 1970 in blue. And then in green, I have since 1971, those years with the same day of the week. And I'm going to trace out that green. This is a model that I'm really paying attention to. It turns up right now, right at the end of July into early August, and it sends higher basically into the beginning of October here. And what is a US dollar? What does a higher US dollar mean? Well, that tends to disrupt a lot of risk markets. Sometimes it's an impediment to sometimes it's an impediment to stocks going higher, commodities and crypto as well. And with all the bearishness on the US dollar, and I totally buy that case, I think the positioning and the sentiment is such, it's so bearish that we could actually see a strong up leg. So that's something I'm going to be on alert for in the month of August. So tune in to Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. More market catalysts after this.
6 months into President Trump's second term, antitrust regulators have already given the green light to more than 100 merger transactions. But the administration's approach to antitrust has been muddled by intra-department infighting. That's according to recent reporting by Semaphore. Here with the details, Semaphore business and finance editor Liz Hoffman. Liz, it's been a minute. It's great to see you. So talk to me about what you discovered in your reporting about what's happening within the Justice Department and how it's informing the sort of merger approval process.
Yeah, thanks, Julie. I mean, the administration's approach to antitrust has just been incredibly hard to puzzle out, which is if you're a CEO, it's almost worse than it being full steam ahead or don't even bother, which was the approach for a lot of the Biden administration. Recently what happened was there was a large deal, HPE trying to buy Juniper, and there was a bit of a kind of very inside baseball kerfuffle where the Justice Department, some executives there basically said to the government, said to the company, deal with us. Like, we don't want to deal with your lobbyists, and sort of pressured it to fire some lobbyists and lawyers and advisors who were themselves like fairly central characters in MAGA world. And it set off a bit of a tug of war between the Justice Department, the Antitrust Division, and kind of the White House. It's still a little unclear. There were two deputies of Gail Slater, who runs the Antitrust Division at DOJ, who like appeared to briefly be fired last week, and maybe in fact are not. But it kind of revealed this deep tension about the approach to corporate consolidation, which is that on the one hand, the kind of base Republican instinct is that M&A is good and Trump himself is a deal maker and sure, let's do it. But you've got these competing priorities, particularly around, what's the pound of flesh that we can get? How can we kind of make this deal better for the White House and for Donald Trump in particular? You have a lot of fairly explosive personalities involved in all of this. And then there's some competing policy priorities, which is I think the White House really does care about helping the U.S. win the AI race with China, which, is one of HPE and Juniper's sort of reasons they say for doing this deal. So it's all just like incredibly hard to muddle out, and is not giving anyone a ton of uncertainty, a ton of clarity at a time when there's a lot of other uncertainty kind of floating around.
Liz, and also, when you're talking about the role of lobbyists here, is there also a bigger takeaway about not just what kinds of deals are going to be approved, but also kind of how they want the lines of communication to work? Or can we not even take that away because these things are all kind of case specific?
I would caution against taking much away. And if you're an M&A lawyer right now and your client comes to you, I'm sorry, and I don't think you have a lot of good answers for them. Try not to go out of your way to offend people in Trump's orbit, which seems like is what happened, at least what was the perception of what happened around HPE and Juniper. But your best bet here, the deals that you've sort of seen get through have some kind of national security first angle to them, whether it's obvious or slightly invented or exaggerated. You could look at U.S. Steel Nippon, which includes this kind of quote golden share for the government. HPE and Juniper kind of belatedly came to the argument that they needed, the U.S. needs to compete with Huawei, and this will help us do it. It wasn't actually really their argument on the way in, and then they realized that it might carry some traction with the White House. One place to watch right now is what's happening in railroads, right? Our reporting suggests that we're probably imminently to see an announced deal between Union Pacific and Norfolk Southern, which would create a transcontinental railroad. The consensus for a long time under both, parties was that we'd seen the end of the railroad consolidation. We were done after the Canadian Pacific Kansas City deal a few years ago. But you might make an argument that Canada has a transcontinental railroad. We should compete with them. And so you're seeing kind of all of these slightly tangential but politically very salient arguments get made to push deals over the finish line. It's probably your best bet.
Yeah, and if all else fails, you offer something to the White House directly, as we've seen in some situations. Also on the deals front, something else that you've been covering, which I thought was really interesting, has to do with Goldman Sachs. And you're reporting finding that maybe they're looking for a pretty big acquisition potentially. So what do we need to know on that front?
Yeah, David Solomon, CEO over there, is on the hunt for something needle moving. When he took the job back in 2018, there was much of was made of the passing of the torch from Lloyd Blankfein and Goldman's traders, who'd kind of run the roost for a while, to its investment bankers. And the read-through was, well, clearly they're going to go do deals. They didn't, mostly because they got bogged down in this big consumer banking mess, trying to kind of unwind some strategically dubious deals that they had done, and they weighed on the stock price, and there was this sort of internal rebellion, and they were in the box with regulators, so they didn't have a lot of leeway. That is all basically, the decks have been cleared of those distractions. Specifically, we reported they'd sort of eyed Northern Trust, which may or may not be in play at the moment. They say they're not, but there's a bunch of companies that seem to find it pretty attractive. Came pretty close to buying Cliffwater, which is about $120 billion of assets in a very popular kind of semi-liquid retail alternatives fund that's sort of the hottest thing on Wall Street right now. They'd have paid $6 billion, I reported for that, pretty big price. So they're likely to do something, I think, quite sizable in asset management. And it's a bit of a reflection of kind of the last couple of years of David's tenure. Again, having cleared the decks, having won back regulators, won back shareholders, won back some internal credibility that had been up in the air for a while.
Yes, I will remember that era. Liz, thank you very much. It's good to see you.
Anytime.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.